Hello and welcome to The Chart Show. I'm Victoria Scholar, and this week's three charts are Twitter, the FTSE 100 and Vodafone. Elon Musk's Twitter acquisition has been called into doubt this week after the billionaire said on Friday that he was putting his $44 billion acquisition on hold after querying the number of fake or spam accounts on the platform, sending shares sharply lower. And there have been more twists and turns this week. On Tuesday, Musk said that Twitter's CEO publicly refused to show proof that spam accounts represent less than 5% of total users, and the deal can't move forward until he does. He added that his offer was based on Twitter's SEC filing being accurate. And on Monday, Twitter slumped another 8% after Musk suggested that he could be seeking to cheapen the deal below the agreed $44 billion price for the microblogging site, citing the idea that there could be at least 4 times more fake accounts than claimed by Twitter itself. In true Elon Musk style, this deal is taking some unexpected turns. The stock is now trading more than 30% below its offer, suggesting that confidence in the deal crossing the line is fading fast. And the big question is, are the bot accounts really concerning Musk, or are they a convenient excuse for him to pull out of the deal, particularly given the slump in Tesla's share price in response? Let's take a look now at the chart, because you can see the stock has had a volatile time lately. The M&A speculation meant that Twitter was bucking the broader weakness in big tech, propped up by hopes of a deal. However, with the deal now called into doubt, a lot of that optimism has started to fade, with the stock under pressure again. Before the Musk approach, Twitter had been struggling, trading in a descending trend line with lower lows and lower highs. If we continue to see more negativity, look for support just above $30, which represents the recent low from February. A break below could pave the way for further declines. It's been a very busy week for UK economic data. On Tuesday, we had unemployment figures, which saw the jobless rate drop to 3.7% in the first quarter. That's the best level since 1974 and ahead of expectations. For the first time ever, there are fewer unemployed people than job vacancies, which hit another record high of nearly 1.3 million, while there was a record number of people switching from economic inactivity to employment. However, while UK employment rose, it's still below pre-pandemic levels. And after accounting for inflation, average pay, including bonuses, rose by 1.4%, but it actually fell by 1.2% when excluding bonuses. We also got inflation figures on Wednesday, which saw April's CPI print hit 9%, a more than 40-year high, jumping from 7% in the previous month as the cost of living starts to bite. The latest jump also marks 7 straight monthly price rises at a pace not seen in a generation, and 9 months of inflation rising faster than the Bank of England's 2% target. Given that economic data, that provides us with a nice opportunity to take a look at the chart of the FTSE 100, because it was enjoying a nice uptrend last year with higher highs and higher lows, peaking in February above 7,600 before tumbling sharply after the war in Ukraine began. Interestingly, we saw the index stage an impressive recovery by April, retesting that February peak again, but it failed to break above that resistance and has since been more volatile. I've annotated the Fibonacci retracement levels on the charts, and you can see now that the index is looking to push through the key 78.6% fib level. If it can break above that level and move towards 7,500, then arguably that could pave the way for the FTSE to retest the high once again. Vodafone reported full-year adjusted core earnings of €15.21 billion on Tuesday, falling short of estimates and coming in at the bottom end of its guidance, while revenue rose by 4% to €45.5 billion. For the current year, Vodafone said earnings growth will come in at around €15 to €15.5 billion. That's below market expectations, while adjusted free cash flow is expected to fall year on year. Vodafone has been facing a series of challenges, from stiff competition and tough regulation that's decreased its pricing power, rising net debt, and a volatile backdrop for financial markets, and of course the geopolitical uncertainty. As a result, Vodafone is looking to pursue mergers with various rivals in order to consolidate and grow inorganically. Last week it was reported that it could be in talks with UK rival 3UK. However, the tie-up has yet to be confirmed. confirmed. Let's take a look now at the chart of Vodafone, because despite initially jumping to the top of the FTSE 100 on Monday amid optimism towards an investment from a UAE telecoms company, that enthusiasm faded during the session with the stock closing lower. And the stock opened lower on Tuesday after earnings, but managed to close just above the flat line. On this long-term chart, you can see that Vodafone shares have been under pressure for several years. A steeper descending trend line back in 2017 was then replaced by a shallow one from 2018 onwards. We can see there appears to be a key long-term support level at the psychological 100 round number handle around the lows from the height of the pandemic. And then on the upside, there looks to be key resistance around 170. Year to date, the stock is little changed, and despite the volatility, the stock is very much struggling for directional momentum. Look for a move up towards resistance at around 170 or down to support at 100 for clues as to where shares go next.